Something just happened in the precious metals market that most retail investors completely missed. While everyone was panicking during the recent flash crash, watching silver plummet and gold test critical support levels, the big banks were doing something they haven't done in years. They were buying. Aggressively. And I'm not talking about your local community bank or some regional player. I'm talking about JP Morgan, Goldman Sachs, the institutions that move billions with a single trade. The same banks that have been on the short side of precious metals for decades just flipped their positioning. And if history is any guide, when the banks flip, the real move is just beginning. Let me walk you through exactly what happened, why it matters, and what it means for anyone holding cash, retirement accounts, or traditional investments right now. Because what we're witnessing isn't just another market correction. It's a fundamental shift in how the world's largest financial institutions are positioning for what comes next, and the implications for your wealth, your retirement, your financial security, they're massive. Here's what most people saw. Gold touched all-time highs. Silver rallied hard. Then boom, a flash crash that wiped out weeks of gains in a matter of hours. Retail investors got shaken out. Stop losses triggered across the board. Social media filled with posts about the precious metals bubble bursting. The usual suspects came out declaring gold and silver dead again. But while everyone was watching the price action and freaking out about their portfolios, something completely different was happening in the institutional market. The banks were accumulating, not just dipping their toes in. We're talking about systematic, aggressive buying that shows up in the commitment of traders' reports, in the ETF flows, in the physical delivery demands at the COMEX. Goldman Sachs just revised their targets upward, not by a little. We're talking about projections that would have seemed insane just a year ago. JP Morgan, the bank that paid nearly $1 billion in fines for precious metals manipulation, the bank that's been the poster child for the short side of this market, they're now forecasting silver averaging over $80 per ounce. Think about that for a second. The same institution that spent years suppressing prices is now telling their clients to get long. When your enemy becomes your ally, you need to pay attention. But here's where it gets really interesting. This isn't just about price targets and analyst reports. This is about actual positioning, real money moving into real positions, the kind of institutional buying that precedes major moves. And it's happening right after a crash that flushed out all the weak hands, all the leveraged retail traders, everyone who was in precious metals for the wrong reasons. It's almost like the crash was designed to create the perfect entry point for smart money. Shake out the tourists, accumulate at better prices, then ride the next wave up. Now, before we go further, I want to mention something quickly. If you're watching this and you've got retirement savings sitting in traditional accounts, I put together a free guide that breaks down exactly how thousands of American retirees are protecting their wealth right now. It's in the description below. No fluff, just the strategies that are actually working in this environment. Grab it while it's still available. Let's talk about what's driving this institutional flip. Because it's not just technical analysis or chart patterns. The fundamentals underpinning this move are unlike anything we've seen in modern financial history. Start with central bank buying. We're not talking about the usual suspects anymore. This isn't just Russia and China diversifying away from dollars. We're seeing central banks from every region, every economic bloc, accumulating gold at a pace that's breaking records quarter after quarter. These aren't speculative trades. Central banks don't buy gold to flip it for a quick profit. They're buying because they see something coming. They're buying because they understand that the current monetary system is under stress in ways that most people don't fully grasp yet. The numbers are staggering. Central banks are buying an average of 60 tons per month. That's not a typo. 60 tons. Every single month. And this isn't slowing down. If anything, it's accelerating. Why? Because the world is fragmenting. The dollar-based system that's dominated global trade for 80 years is showing cracks. Not because the dollar is going to zero tomorrow, not because America is collapsing, but because the world is multipolar now. Countries want options. They want insurance. They want assets that aren't someone else's liability. And there's only one asset that fits that description and has for 5,000 years: gold. But here's what makes this moment different from previous gold rallies. It's not just central banks. It's not just geopolitical tension. It's the convergence of multiple massive trends all hitting at the same time. You've got the monetary debasement story. You've got the geopolitical fragmentation story. You've got the supply shortage story. And now you've got the institutional positioning story. When all these forces align, you don't get a normal bull market. You get something much bigger. Let's dig into the supply side because this is where things get really interesting. Silver production has been flat to declining for years. The easy deposits have been mined. The ore grades are getting lower. The cost of extraction is rising. Meanwhile, demand is exploding. Not just investment demand, industrial demand. Silver is critical for solar panels, for electric vehicles, for 5G infrastructure, for the entire green energy transition that governments around the world are mandating. You can't build the future without silver. And we're not mining enough of it to meet current demand, let alone future demand. The silver market is tiny. The entire above-ground supply of investment-grade silver is worth less than the market cap of a single large tech company. When institutional money starts flowing into a market that's small, the price moves are exponential. And that's exactly what we're starting to see. The banks know this. They've done the math. They understand that silver at current levels, even after the recent rally, is still historically cheap relative to gold, relative to industrial metals, relative to almost any other commodity you can name. Gold is a different story but equally compelling. Gold isn't about industrial demand. Gold is about trust, or more accurately, the lack of it. When people lose faith in paper currencies, in government promises, in the ability of central banks to maintain stability, they turn to gold. Not because gold pays interest, not because gold generates cash flow, but because gold is the ultimate form of money that can't be printed, can't be debased, can't be created out of thin air by a central bank with a keyboard. And right now, trust in the system is eroding. Not catastrophically, not in a way that makes headlines every day, but steadily, persistently, like water wearing away stone. Every time inflation runs hotter than expected, trust erodes. Every time a bank fails, and depositors wonder if their money is safe, trust erodes. Every time a government announces another trillion-dollar spending package with no plan to pay for it, trust erodes. And every time trust erodes, gold becomes more valuable. The banks see this. They have access to data that retail investors never see. They have economists, strategists, analysts running models on every possible scenario. And their models are telling them the same thing. The next decade is going to be very different from the last decade. The playbook that worked when interest rates were zero and central banks were printing money to support asset prices, that playbook doesn't work anymore. We're in a new regime. And in this new regime, hard assets matter. Real things matter. Gold and silver matter. Here's something most people don't understand about institutional positioning. When banks like JP Morgan and Goldman Sachs flip from short to long, they're not making a bet. They're making a calculated decision based on information and analysis that costs millions of dollars to produce. These institutions don't gamble. They don't hope. They position based on probability-weighted outcomes across multiple scenarios. And right now, their positioning is screaming that precious metals are going significantly higher. But it's not just about the banks. Look at what's happening in the ETF market. After the flash crash, you'd expect to see massive outflows as scared investors head for the exits. That's what usually happens, but that's not what we're seeing. The outflows were minimal. In some cases, we're actually seeing inflows. That tells you something important. The holders of these ETFs aren't tourists. They're not weak hands. They're investors who understand the thesis, who bought for the right reasons, who see the crash as noise rather than a change in the fundamental story. And then there's the physical market. This is where things get really interesting. Because while paper prices were crashing, physical premiums were spiking. The spread between spot price and what you actually pay for a physical coin or bar widened dramatically. That's not normal. In a real crash, physical premiums collapse because nobody wants the stuff. But that's not what happened. Physical premiums spiked because demand for actual metal increased during the crash. People were buying the dip, not on paper, in physical form. That's incredibly bullish. The COMEX delivery demands are another piece of the puzzle. More and more contracts are standing for delivery rather than rolling or settling in cash. That means people want the actual metal, not just price exposure. And when delivery demands increase, it puts pressure on the entire paper market structure, because the paper market is built on the assumption that most contracts will settle in cash. When that assumption breaks down, when people start demanding physical delivery in size, the whole system gets stressed, and that stress shows up as higher prices. Now let's talk about what this means for the average person, because this isn't just an academic discussion about institutional positioning and market structure. This is about your wealth, your retirement, your ability to maintain your standard of living in an environment where everything is getting more expensive, and traditional safe havens aren't safe anymore. If you're holding significant cash, you're losing purchasing power every single day. The official inflation numbers don't capture the real cost of living increases that most people are experiencing. Your grocery bill knows the truth. Your utility bills know the truth. Your insurance premiums know the truth. Cash is not safe. It's guaranteed to lose value over time, and the rate of loss is accelerating. If you're in traditional stocks and bonds, you're exposed to a system that's increasingly fragile. We've had over a decade of artificially low interest rates that inflated asset prices to levels that don't make sense based on fundamentals. Now that rates have normalized, those valuations are under pressure. And if we hit any kind of real economic stress, if we see a recession, if we see a credit event, traditional portfolios are going to get hammered. This is where precious metals come in, not as a speculation, not as a get-rich-quick scheme, but as insurance, as a hedge against all the things that can go wrong in a system that's built on debt, leverage, and the assumption that central banks can always save the day. Gold and silver have been insurance for 5,000 years. They've survived every empire, every currency, every financial system that's ever existed. They'll survive whatever comes next. And here's the thing about insurance. You don't buy it after the house is on fire. You buy it when things seem fine, when the sun is shining, when everyone else thinks you're being paranoid. Because by the time everyone realizes they need insurance, it's too late. The price has already moved. The opportunity is gone. The banks understand this. That's why they're positioning now. Not when gold is at $10,000 and silver is at $200. Now, when prices are still reasonable, when most people are still skeptical, when the mainstream narrative is still that precious metals are a barbarous relic with no place in a modern portfolio. Let me tell you a story that illustrates this perfectly. Back in the early 2000s, there was a hedge fund manager who saw what was coming. He saw the housing bubble, the leverage in the system, the derivatives time bomb, and he started buying gold. Not a little, a lot. His investors thought he was crazy. Gold wasn't doing anything. The stock market was going up. Real estate was going up. Why waste money on a metal that just sits there? But he kept buying. And when 2008 hit, when the financial system nearly collapsed, when stocks crashed and real estate imploded, his gold position saved his fund. While everyone else was down 30, 40, 50%, he was up. Because he understood that insurance isn't about making money in good times. It's about surviving bad times. We're in a similar moment right now. The system looks stable on the surface. Markets are functioning. Banks are open. Life goes on. But underneath, the stresses are building. The debt levels are unsustainable. The geopolitical tensions are escalating. The monetary system is fragmenting. And the people who understand this, the institutions with the resources to analyze it properly, they're positioning for what comes next. They're buying gold and silver, not because they think it's going to double next week, but because they think it's going to be one of the few assets that maintains value when everything else is in chaos. Now, speaking of protecting wealth, if you're sitting on $100,000 or more in retirement accounts, there's something you need to know. A lot of people don't realize you can actually hold physical gold in a retirement account without tax penalties. It's called a gold IRA, and it's one of the most powerful wealth protection tools available right now. I put together a comprehensive guide that walks through exactly how it works, the pros and cons, what to watch out for. It's in the description. If you've got significant retirement savings and you're concerned about market volatility, geopolitical risk, currency debasement, any of the things we're talking about here, it's worth checking out. No obligation, just information that could be incredibly valuable for your situation. All right, back to the institutional move. Let's talk about timing, because one of the questions I get all the time is, if this is such a sure thing, why isn't everyone doing it? Why isn't gold at 20,000 already? Why isn't silver at 500? And the answer is that markets don't move in straight lines. They move in waves. And right now, we're at the beginning of a wave. Not the middle, not the end, the beginning. Think about how bull markets work. They start with smart money accumulating quietly while everyone else is skeptical. That's where we are now. The banks are buying. The central banks are buying. The people who understand the macro picture are buying. But the general public isn't paying attention yet. Precious metals aren't on the front page. They're not trending on social media. Your neighbor isn't talking about his gold coins at the barbecue. That's perfect, because it means there's still time to position before the crowd shows up. The next phase is when the trend becomes obvious. Prices start moving consistently higher. The financial media starts covering it. Analysts start upgrading their targets. Momentum traders start piling in. That's when you get the big moves. That's when gold goes from 5,000 to 8,000, when silver goes from 80 to 150, when everyone who ignored it at lower prices suddenly can't get enough of it. And then you get the final phase, the mania phase, when your Uber driver is giving you tips on silver mining stocks, when there are lines around the block at coin dealers, when every financial show is talking about nothing but precious metals. That's when you sell. That's when you take profits and wait for the next cycle. But we're nowhere near that yet. We're still in the accumulation phase, the smart money phase, the phase where the real money is made. The banks know this. They've seen this cycle play out multiple times. They know that the best returns come from buying early and holding through the volatility. And that's exactly what they're doing right now. They're not trying to time every wiggle in the price. They're building positions that they plan to hold for years, because they understand that the macro forces driving this move aren't going away. If anything, they're intensifying. Let's talk about some of those macro forces in more detail. Start with the debt situation. The United States has over $30 trillion in federal debt. That number is growing by trillions every year. There's no plan to pay it down. There's barely even a discussion about slowing the growth. And it's not just the US. Japan's debt to GDP is over 200%. Europe is drowning in debt. China has a massive debt problem that they're trying to manage without triggering a crisis. The entire global economy is built on a foundation of debt that can never be repaid in real terms. So, what happens? The debt gets inflated away. Central banks keep interest rates low enough that governments can service their debt without going bankrupt. But that means currency debasement. It means your dollars, your euros, your yen, they buy less every year. Not because of some conspiracy, but because it's the only way out of a debt trap this big. And when currencies are being debased, hard assets like gold and silver maintain their value. They're not going up in real terms. The currency is going down, but the effect is the same. Your purchasing power is preserved. Then, you've got the geopolitical situation. The world is more divided now than at any point since the Cold War. You've got the US and China in a strategic competition that's going to define the next century. You've got Russia operating outside the Western financial system. You've got the Middle East in constant turmoil. You've got trade wars, technology wars, currency wars. And in that environment, countries want assets that aren't dependent on any single nation or alliance. They want gold. Because gold doesn't care about politics. It doesn't care about sanctions. It doesn't care about who's in power. It just is. The BRICS nations are actively working to create alternatives to the dollar-based system. They're settling trade in local currencies. They're building payment systems that bypass SWIFT. They're accumulating gold to back these new arrangements. This isn't happening overnight. But it's happening. And every step in that direction makes gold more valuable. Because gold becomes the neutral settlement asset in a multipolar world. It's the one thing everyone trusts when they don't trust each other. And then there's the technology angle that most people miss. The green energy transition requires massive amounts of silver. Solar panels use silver. Electric vehicles use silver. The electrical grid upgrades needed to support all this use silver. We're talking about decades of sustained industrial demand at levels we've never seen before. And we're not increasing supply fast enough to meet it. That's a recipe for much higher prices. The banks know this. They've done the analysis. They understand that silver isn't just a monetary metal anymore. It's a critical industrial commodity in a world that's electrifying everything. The same dynamics apply to gold in different ways. Gold is increasingly being used in electronics, in medical devices, in aerospace applications. But more importantly, gold is being remonetized. Central banks are treating it as a Tier 1 asset again. It's not just a barbarous relic sitting in a vault. It's an active part of monetary policy. And as the dollar's dominance slowly erodes, as the world becomes more multipolar, gold's role as the ultimate neutral reserve asset becomes more important. Here's what a lot of people don't understand. The price of gold and silver isn't just about supply and demand in the traditional sense. It's about monetary dynamics. It's about how much currency is being created relative to how much gold and silver exists. And right now, currency creation is running at levels that would have been unthinkable a generation ago. Every major central bank is running deficits that require massive money printing to finance. That money has to go somewhere. And increasingly, it's going into hard assets, real estate, commodities, and especially precious metals. The banks see this flow happening. They see the money supply numbers. They see the fiscal deficits. They see the political impossibility of actually addressing these issues in any meaningful way, and they're positioning accordingly. Not with press releases, not with public announcements, but with actual trades, real positions, money moving into gold and silver at a scale that tells you everything you need to know about what they really think is coming. Now, let's talk about what happens next. Because understanding the setup is one thing, understanding how it plays out is another. Based on historical patterns, based on the current positioning, based on the macro environment, here's what we're likely to see. First, continued volatility. The path higher isn't going to be smooth. There will be pullbacks. There will be shakeouts. There will be moments when it looks like the rally is over. That's normal. That's healthy. That's how bull markets work. They climb a wall of worry. They shake out weak hands. They create opportunities for those who understand the bigger picture. Second, we're likely to see gold lead the way initially. Gold is the larger, more liquid market. It's what institutions buy first. It's what central banks accumulate. Silver tends to lag gold in the early stages of a bull market, then outperform dramatically in the later stages. So, if you're watching the gold-silver ratio, if you're seeing gold make new highs while silver consolidates, that's not a problem. That's the normal pattern. Silver's time will come. And when it does, the moves will be explosive. Third, we're going to see increasing mainstream attention. Right now, precious metals are still off most people's radar, but as prices continue higher, as the bank's positioning becomes more obvious, as the macro story becomes impossible to ignore, the narrative will shift. The same analysts who've been calling gold a bubble will start upgrading their targets. The same media outlets that ignored precious metals will start covering them extensively. And that's when the real money flows in. That's when retail investors, pension funds, sovereign wealth funds, everyone who's been sitting on the sidelines, they all start buying. And that's when you get the parabolic moves. Fourth, we're likely to see supply constraints become a real issue. The paper market can create infinite supply. You can sell as many futures contracts as you want, but the physical market is different. There's only so much actual metal. And if demand for physical delivery continues to increase, if more and more investors want the real thing rather than paper promises, the system gets stressed. Premiums widen, delivery delays increase, and eventually the paper price has to adjust to reflect physical reality. That adjustment could be dramatic. Fifth, we're going to see gold and silver increasingly decouple from other assets. Right now, they still trade with some correlation to stocks, to bonds, to the dollar. But as the monetary dynamics become more extreme, as the macro picture becomes more clear, precious metals will start moving on their own fundamentals. They'll become true safe havens, true stores of value, and their correlation to other assets will break down. That's when you know the bull market is really underway. The banks are positioning for all of this. They're not trying to catch every move. They're building strategic positions that will benefit from the multi-year trend. And if you understand what they're doing, if you understand why they're doing it, you can position alongside them. Not with the same resources, not with the same information, but with the same basic understanding of where this is headed. Here's the bottom line. The banks just flip to buy, not because they're bullish on gold and silver in some abstract sense, but because their analysis tells them that precious metals are going to be one of the best performing asset classes over the next several years. They see the monetary debasement. They see the geopolitical fragmentation. They see the supply constraints. They see the increasing institutional adoption. And they're acting on it. With real money. In size. You can ignore this. You can stick with the conventional wisdom that says gold is a barbarous relic and silver is just an industrial metal. You can keep all your wealth in dollars and stocks and bonds and hope that the system holds together. Or you can pay attention to what the smart money is doing. You can recognize that we're at an inflection point. You can position yourself for what's coming rather than what was. This isn't about getting rich quick. This isn't about making a killing on some speculative trade. This is about wealth preservation. This is about making sure that the money you've worked your entire life to accumulate doesn't evaporate in a monetary crisis or a market crash or a geopolitical event that nobody saw coming. This is about insurance. And the time to buy insurance is before you need it. The banks understand this. That's why they're buying now. Not when gold is at 10,000 and everyone's talking about it. Now, when most people are still skeptical, when the opportunity is still real, when you can still position at prices that will look incredibly cheap in hindsight. So what should you do? First, educate yourself. Understand the fundamentals. Understand why precious metals matter. Understand the role they play in a diversified portfolio. Don't just take my word for it. Do your own research. Look at the data. Look at what the institutions are doing. Look at what central banks are doing. Form your own conclusions.